video is for educational purposes only and is not financial advice. Always do your own research before investing.
Let's start with the basics. BIGY evolves the US Equity UltraYield ETF. It launched in September 2025 and is listed on the Toronto Stock Exchange. The fund is actively managed and focused on generating high cash flow from concentrated portfolio leading US companies. As of mid-July 2026, it managed roughly $333 million in assets, hold 23 companies, charges 0.40% management fee, and pays distribution twice every month. It is also eligible for registered account like TFSA or RRSP. So, what BIGY actually does? BIGY combines three components. It owns large US companies, in this case, it's 23 companies, and then write cover calls on approximately 50% of the portfolio by using 33% of the leverage. Many investors may ask, why 50% covered call? Why not more than 50%? Why not 100%? Because then upside becomes heavily limited. BIGY targets approximately 50%, allowing half of the portfolio to continue participating more fully into market gains if the market proceeds to go upwards. Half the portfolio to generate option income through deploying 50% of the total value of the portfolio. So, what are the benefits of this strategy? Definitely huge cash flow, professional option management, two distributions every month, exposure to large US companies, and single ticket solution. Now let's talk about the BIGY strategy risks. Because every investment has trade-off and BIGY is no exception, the first and probable biggest risk is its leverage. BIGY can use up to 33% of leverage, which means for every $100 invested by a shareholder, the fund can control roughly 133 worth of assets. That works well when markets are rising because gains are amplified. But the opposite is also true. During market corrections, losses can happen faster than they would be in the traditional ETFs. So leverage is a double-edged sword. It can boost return, but also it can increase volatility. The second risk is the covered call strategy. BIGY writes covered call on all approximately half of the portfolio. The benefit is that it earns option premium, which helps generate the fund's high cash distributions. The downside is that if the underlying stocks surge sharply, part of the upside may be capped because those call options have been sold. In other words, BIGY may not fully participate in strong bull market. The third risk is NAV erosion. This is one of the most important things I watch with high income ETFs. A high distribution looks so attractive, but the real question is whether the fund is generating enough income and returns to support those payments over time. If distribution consistently exceeds what the portfolio earned, the fund net asset value or NAV will gradually decline. That's why in every Dividend North ETF health check, NAV health is one of the biggest section of the review. Another consideration is market risk. Although BIGY focus on large established US company, it is still an equity fund. If the overall US market falls, BIGY will also be affected. The quality of the company can help over the long term, but they are not immune to market downturns. There is also interest rate related risk. Because borrowing costs can change, higher interest rate may reduce the benefit of using leverage and can put pressure on future returns if borrowing become more expensive. Finally, investors should understand that BIGY has a limited operating history. It launched in 2025, so we don't have many years of data across different market cycles. That doesn't mean it's poor investment. It simply means there's a less historical evidence to judge how the strategy performed during prolonged bull market, bear market, or changes interest rate environment. My overall view will be I don't see BIGY as a low risk ETF. I see it as a high risk, high income strategy designed for investors who understand leverage, covered calls, and who are comfortable with greater price volatility in exchange of potential higher cash flow. If your priority is maximizing monthly income and you are willing to accept those trade-offs, BIGY could be worth considering as part of your portfolio. But if your main goal is long-term capital growth and lower volatility, a traditional broader market ETF may be better fit. Now let's look at this BIGY chart. As you can clearly see, if you compare this against other ETF available in the market, HTA or ZWT or QQCL, it's definitely lagging in 1 year chart. Its performance is way below compared to these three ETFs, which are also exposed to similar top technology company in the sector. Now, definitely the question has to be asked, will be BIGY able to recover the losses it has suffered so far with the strategy the company is employing? So keeping this in mind, before you buying BIGY, it could be a yield trap, it could be a NAV erosion, it could be a too aggressive strategy which is causing BIGY such a big loss. So my main purpose is to make you aware that only yield percentage is not the decision maker to buy an ETF. It has to be long-term performance. It has to be total return as well, so that you should not be losing money at the end of the day. I strongly believe every investor should look beyond yield. BIGY offers a compelling income strategy, but because it is still a young ETF, I wanted to see how its NAV behaves through multiple market environments before making stronger long-term conclusions. Right now, I would describe its NAV health as encouraging but still developing. Thanks for watching my channel, guys. See you in the next video.